Hello everyone, I'm Jared Hall. It's Monday, March 31st, 2025. Welcome to the week ahead. The S&P 500 index declined 1.5% last week after the Bureau of Economic Analysis released the Federal Reserve's preferred inflationary gauge, the PCE, which came in hotter than economists had expected. The fear of a resurgence in inflation added conviction to the belief that reciprocal tariffs levied by the new Trump administration may add to inflationary pressures. If inflation ticks higher, the Federal Reserve may be forced to leave their benchmark interest rates higher than desired, thereby dampening economic activity longer than may be ideal. Markets this Monday opened lower in a volatile fashion, while the technology-weighted NASDAQ sector felt the worst of the pain, dropping 14.75% from previous all-time highs. Even the Dow Jones Industrial Average has not shaken off the pain in the U.S. market this year, falling over 7%. The declines in the broadest index, the S&P 500, have been deep enough to wipe out returns since July of last year. The key data last week came out in two parts. Part one being the consumer spending data for February, which came out at a 0.4% month-over-month rate pace. This was slightly below the 0.5% increase expected from economists. This was followed by the PCE data, which focuses more on pricing and came in on a core basis at 0.4% month-over-month and 2.8% year-over-year. Both of these data points mean inflation is still well ahead of the Federal Reserve's 2% target. A quick look at last week's market sectors show that only real estate, energy, and consumer sectors were able to withstand the broad declines. Tech led the downside risk last week. Lastly, looking at the technical chart of the S&P 500, it looks like the market bounced right into resistance over the previous 2 weeks, which coincided with a declining moving average. This is highlighted in the blue circle. After today's market opening, the index is back at year-to-date lows and recent support levels. This is highlighted by the base of the blue rectangle in the image. It will be interesting to see if support can hold this level this week or if the market breaks through and needs to find new buyers. We'll talk more about this after we look at the news that may impact markets for this week. Markets will be keying on new announcements about reciprocal tariffs from the Trump administration and the future developments of those tariffs, before ending the week with the monthly jobs report due out for the month of March. Markets will be looking at how jobs data and jobs in general are holding up in the midst of cuts from Doge and a slowing economy. The last chart we wanted to share showcases the annual returns of the S&P 500, along with the intra-year pullbacks in those years. We'd like to highlight that in almost every positive year the market has, it is normal for a pullback to occur. And if you include negative market years, the average pullback is around negative 16% going back to 1996. This is the risk that long-term investors have to endure to generate returns, so stick to your plan. That's all for this week. Thanks for watching. Be sure to follow along with us for more content like this.